There's a certain seduction in the word cheap. To the enterprising investor, it sounds like opportunity, the kind Graham himself sought throughout his remarkable career. A stock trading at a low multiple, a share price below book value, or a company overlooked by the market. It feels like a bargain waiting to be discovered. But, as Graham warned repeatedly, not every cheap stock is a true bargain. Some are cheap because they deserve to be. Others are cheap because their future is far less certain than their numbers suggest. And this, right here, is the essence of what we call a value trap. An investment that looks undervalued but continues to underperform, eating away at both your capital and your confidence. I've always found it fascinating how Graham, often portrayed as the ultimate bargain hunter, actually spent much of his life learning how not to be deceived by the illusion of cheapness. He began his career at a time when information was scarce, financial statements were crude, and the market was filled with supposed bargains that were little more than ticking time bombs. Think back to the 1930s, the aftermath of the Great Depression. Stock prices had collapsed, and everywhere you looked, companies were trading below their book value. Some even sold for less than the cash they held in the bank. To most investors, it looked like the deal of a lifetime. And yet many of those bargains never rebounded. Their businesses were broken beyond repair. Some industries were entering permanent decline, and no discount could compensate for a future that was disappearing. Graham learned the hard way that cheapness alone isn't safety. A stock that looks inexpensive today might still be overpriced if its earning power is fading or its management is reckless. He realized that true value isn't found in low prices, it's found in sound businesses. Today, the same illusion persists. Investors chase stocks trading at single-digit PE ratios, or those that have fallen 80% from their peaks, convinced that the only direction left is up. But history, as Graham would remind us, rarely rewards that kind of thinking. In Graham's world, and in ours, markets often disguise danger as opportunity. The numbers can tempt you, but they rarely tell the full story. And as we'll see, it was precisely this painful realization that not all bargains are created equal that forced Graham to redefine what value really means. But as Graham discovered early in his career, not every bargain is a true bargain, and the difference can define an investor's lifetime of results. In the turbulent years following the crash of 1929, Wall Street was littered with wreckage. Thousands of companies saw their share prices plunge by 80% or more. To a young analyst like Graham, it seemed like the perfect hunting ground. Stocks were trading for fractions of their previous prices, and many appeared to be selling far below their liquidation value, meaning if you sold off all their assets, they'd be worth more dead than alive. At first glance, that sounds like the ultimate investor's dream. And for a time, it was. Graham built early success buying these battered securities, believing that mathematical cheapness offered safety. The numbers were compelling. He often said, "The market is there to serve you, not to instruct you." And in those years, it seemed the market was serving bargains by the dozen. But then came the harsh lessons. Many of these so-called bargains never rebounded. Entire industries like railroads, coal mining, and certain manufacturing sectors were declining structurally. Their so-called cheap stock prices weren't mistakes. They were reflections of grim reality. Graham watched companies with solid-looking balance sheets crumble because their business models no longer worked. The assets that once looked so valuable became useless when the world changed around them. He later admitted that in those early years, he had been too dependent on figures, too little on facts. It wasn't enough for a company to look undervalued on paper. What mattered was whether its earning power, its ability to produce sustainable profits, could justify its existence in the future. One striking example came from the early 1930s. Many railroads were trading for less than their tangible assets. To a statistician, that screamed opportunity. Yet the rise of automobiles and highways was eroding their dominance. What looked like a temporary undervaluation
was actually a long-term decline. Investors who clung to those stocks found that time was not their ally. And this wasn't just a story of old industries. Even today, investors fall into the same pattern. Consider the retailers that looked cheap a decade ago, companies like Sears or J.C. Penney. They had real estate, brand recognition, and massive inventories. On paper, they seemed undervalued. But their business fundamentals were deteriorating faster than their balance sheets could protect them. The lesson, then as now, is simple, yet profound. A low price doesn't make an investment safe. In fact, sometimes it's the market's way of signaling deeper trouble. For Graham, this realization was transformative. It forced him to look beyond the surface and ask a more penetrating question, one that would shape his entire philosophy going forward. He began to wonder, if a stock can look cheap but still destroy value, then what truly separates a bargain from a trap? To understand how Graham unraveled this question, we must first dissect what a value trap really is. On the surface, it's deceptively simple. A stock that appears undervalued by traditional measures, but continues to decline or stagnate. Yet beneath that surface lies a complex mix of financial illusion, psychological bias, and business decay. Graham learned to identify certain red flags, patterns that repeated themselves across decades of market history. He came to see that value traps tend to share four common traits. First, declining earnings disguised by low valuation multiples. When profits are shrinking year after year, the price-to-earnings ratio may look attractively low, but it's often because investors are already discounting a bleak future. The illusion of cheapness hides a deteriorating business underneath. Second, a weak competitive position or fading industry. Even a well-managed firm can't fight structural decline. The railroads of the 1930s, the textile mills of the 1950s, or the newspaper companies of the early 2000s all looked cheap at some point, yet their industries were being overtaken by technology or changing consumer behavior. Third, management indifference. Graham placed great emphasis on shareholder orientation. Companies that ignored capital allocation, hoarded cash, or refused to adapt were often the worst offenders. He often warned that management's unwillingness to face reality could keep a company undervalued indefinitely. And fourth, a fragile financial structure. Excessive debt, thin margins, or inconsistent cash flow, these, Graham observed, turned an apparent bargain into a potential disaster. When downturns arrived, such companies had no cushion to survive. Graham wasn't just cataloging failures, he was distilling patterns of risk. He realized that what made these companies dangerous wasn't their valuation, it was their vulnerability. The numbers alone could never tell the full story. Even in his own day, he saw examples of this trap. After World War II, as America transitioned to a peacetime economy, numerous manufacturers looked cheap on paper. Their inventories were full, their earnings temporarily high, and their stock prices modest. But when demand collapsed and government contracts vanished, those same businesses imploded. It was around this time that Graham began to see the flaw in purely quantitative analysis. His earlier approach, buying stocks below net current asset value, had served him well in the depths of the Depression, when panic created extreme mispricings. But as markets normalized, those opportunities became rare. The margin for error shrank, and the risks of falling into value traps grew larger.
So Graham made a subtle but profound shift. He began to ask not just, what is this company worth if liquidated, but rather, what can this company earn if conditions normalize? It was the start of his transition from focusing on static assets to dynamic earnings, a change that would redefine the way intelligent investors approached value.
And it's here, in this transformation, that we see one of Graham's greatest insights emerge, that true value lies not in what a company owns, but in what it can sustainably earn. But that shift didn't happen overnight. It was forged through trial, reflection, and the painful recognition that numbers can lie if you don't understand the business behind them. By the 1940s, Graham's thinking had evolved dramatically. The world had changed. Industries were expanding. Financial statements were improving, and investors had access to more information than ever before. The old practice of buying net nets, companies trading below the value of their liquid assets, was becoming less effective. Those opportunities still existed, but they were fewer and often concentrated in troubled businesses. Graham realized that survival and long-term success depended not just on the balance sheet, but on the business's earning power, its ability to generate profits consistently over time. A company with strong and reliable earnings, even if it looked moderately priced, could often be a better investment than one trading far below its tangible assets but bleeding cash. This was a pivotal turning point in his career and in the history of investing itself. Graham began emphasizing qualitative judgment alongside quantitative analysis. He still believed in rigorous valuation, but he understood that numbers without context could deceive even the most careful analyst. He often spoke of the importance of future earning power, what a business could earn under normal conditions, not just during booms or slumps. The goal, he said, was to estimate intrinsic value not as a static number, but as a reflection of sustainable business performance. In security analysis, Graham used numerous examples to illustrate this evolution. He examined companies with impressive asset bases but weak earning potential, and others with modest assets but durable profitability. Time and again, he found that markets rewarded the latter far more consistently. One of Graham's most profound observations was this: the value of a business is determined by its earning power, not its balance sheet. This idea reshaped his entire approach. He was no longer hunting for liquidation value. He was searching for enduring value. Take, for example, the case of certain utilities and consumer goods firms in the post-war era. They weren't flashy, and their stocks rarely made headlines, but their earnings were steady, their dividends dependable, and their management conservative. To Graham, these were the true gems, companies that could preserve and grow value without requiring perfect timing or speculative risk. Contrast that with the industrial giants that looked cheap after the war. Many had massive physical assets and impressive book values. Yet, as demand cycles shifted and inflation pressures grew, their profits became erratic. What once appeared to be safe investments turned into textbook examples of value traps, businesses rich in assets but poor in adaptability. Graham distilled it into a simple, enduring principle. The margin of safety must be based not only on undervaluation, but on the quality and stability of the underlying business. This insight remains as relevant today as it was in his time. Modern investors still fall into the same trap, mistaking low price-to-earnings ratios or discounted book values for genuine value, while ignoring the company's competitive strength and earning resilience. In the age of technology and disruption, the distinction is even more critical. A company might look cheap compared to its past, but if its core business model is eroding, no spreadsheet can save you.
And so Graham's shift from assets to earnings was more than an analytical adjustment. It was a philosophical awakening. It marked his realization that the greatest danger in investing isn't volatility or market noise, but misplaced confidence in numbers that no longer tell the truth. But even that insight, as powerful as it was, didn't fully protect investors, because Graham understood that numbers and analysis alone couldn't solve one of the deepest challenges in investing, the psychology of the investor himself. And so he turned his attention to a subtler but far more dangerous threat, the emotional trap that blinds even the most intelligent investor.
Graham often said that the market is not a weighing machine in the short term, it's a voting machine. That simple observation reveals one of the most powerful yet easily forgotten truths about investing. Prices are shaped by human emotion far more than by arithmetic. When investors fall into value traps, it's rarely because they misread a balance sheet. It's because they overestimate their ability to remain objective when hope and fear cloud judgment. In his lectures and writings, Graham described how investors, even experienced professionals, could become emotionally attached to their analyses. They see a company trading at half of its book value, calculate what looks like an irresistible margin of safety, and then begin to rationalize away the warning signs. He called it the illusion of cheapness. A company appears undervalued, but in truth, the market may be discounting it for good reason. Declining sales, outdated products, poor management, or an eroding competitive position. Yet the investor, convinced of his superior insight, mistakes the market's pessimism for opportunity. This is where Graham's concept of Mr. Market becomes essential. He imagined the market as a manic depressive partner who shows up every day with a new price for your shares, sometimes euphoric, sometimes despondent. Your job, Graham said, is not to match his mood, but to take advantage of his emotional swings. In the context of value traps, Mr. Market can be particularly deceptive. When prices fall sharply, he whispers, "This is your chance. The stock is cheap now." But Graham warned that cheapness alone is not value. True value must be supported by quality, stability, and future prospects, not simply by a low price tag. He gave examples of once great businesses in the 1930s and 1940s that had fallen on hard times. Railroads, for instance, were trading at fractions of their book value. To the untrained eye, they looked like bargains. But Graham understood that the railroad industry was entering a structural decline due to competition from automobiles and trucks. Those companies weren't temporarily depressed, they were permanently impaired. The modern investor faces the same psychological challenge. Consider industries disrupted by technology, once mighty retailers overtaken by e-commerce, or traditional media companies struggling against digital platforms. Their stock prices may look cheap compared to their historical valuations, but if their business models are crumbling, the low price simply reflects reality. Graham's advice was to separate price decline from value opportunity. A falling price might signal a true bargain, or it might reveal deeper problems. The key, he said, lies in discipline, refusing to confuse volatility with mispricing, and emotion with insight. He was deeply aware of the emotional traps that investors set themselves. Hope is seductive. It convinces us that a turnaround is coming, that the market is wrong, that our analysis is superior. Yet in investing, optimism without evidence is just another form of speculation. Graham's antidote was clear thinking and humility. The investor's chief problem, and even his worst enemy, is likely to be himself. He wrote those words in The Intelligent Investor, and they remained the cornerstone of value investing psychology.
The lesson is timeless. Don't let pride, fear, or hope distort your reasoning. The market may tempt you with cheap opportunities, but your first responsibility is to preserve capital, not to chase illusions. But Graham didn't stop at diagnosing the problem. He offered a method to detect and avoid value traps before they ensnare the unwary. His framework for analysis went beyond simple ratios, introducing a more holistic approach that balanced numbers, business quality, and investor temperament. And that's where we turn next, to the analytical tools and mental models Graham used to separate temporary misfortune from permanent decline. Graham was a man who believed that numbers tell stories, but only if you know how to listen. He developed an analytical framework that helped him distinguish between companies that were merely cheap and those that were truly undervalued. At the core of his method was what he called quantitative and qualitative balance. He argued that the intelligent investor should not rely solely on financial ratios, nor should they be swayed purely by narratives about a company's future. Instead, they should blend rigorous number crunching with sound judgment about the business itself. The first step in Graham's process was the quantitative screen. He looked for companies with low price-to-earnings ratios, low price-to-book ratios, and strong balance sheets, especially those with little or no debt. He preferred companies that paid dividends consistently, as that was a sign of financial discipline and management accountability. But here's where Graham differed from many investors of his time, and even many today. He didn't stop at the ratios. Once a company passed the numerical test, he examined its qualitative reality. Was the business model sustainable? Were its earnings stable across different economic cycles? Did management act prudently, or were they speculators in disguise? He described this process vividly in security analysis, saying, "Numbers alone are not sufficient. Behind every figure lies a human factor, management, whose character and judgment can turn a good balance sheet into a poor investment." To illustrate, consider one of Graham's classic case studies from the 1930s, the Northern Pipeline Company. It was a relatively obscure enterprise that owned stock in other businesses and held large cash reserves. On paper, its shares were trading far below the value of its assets. But unlike many cheap stocks of the era, Northern Pipeline was profitable, conservatively managed, and had no operational troubles. It was a genuine case of undervaluation. Graham bought shares when others ignored it, profited handsomely, and later used it as a teaching example of what a real bargain looks like. Contrast that with the many fallen angels of the same period, glamorous companies that had collapsed in price after the crash of 1929. Their stocks appeared cheap by traditional measures, but their businesses were irreparably damaged. Graham avoided them precisely because he understood that not all declines lead to recovery. In today's world, the same principle applies. A company may trade at a single-digit PE ratio. Yet, if it operates in a dying industry or has a structurally flawed business, it is not undervalued, it's simply less expensive on the way to zero. Modern examples abound. Traditional retailers disrupted by e-commerce, once dominant smartphone makers overshadowed by innovation, or energy firms slow to adapt to changing markets. Their stocks may look cheap compared to past earnings, but if those earnings are no longer repeatable, the value is an illusion. Graham's solution was what he called margin of safety. This was not just a mathematical cushion. It was a philosophical stance. He believed investors should buy only when the gap between price and intrinsic value was wide enough to protect against both analytical errors and unforeseen events.
He wrote, "The purpose of the margin of safety is to render unnecessary an accurate estimate of the future." That line captures the essence of his wisdom: humility in the face of uncertainty. He didn't pretend to predict the future. Instead, he sought to invest in situations where he didn't need to. That's how one avoids value traps, by insisting on such a significant discount to fair value that even if your analysis is partly wrong, your capital remains protected. And that principle, the margin of safety, has guided generations of investors since. Warren Buffett called it the 3 most important words in investing. Yet, as powerful as it is, Graham also recognized that avoiding value traps requires not just analytical discipline, but emotional restraint. The ability to act rationally when the market tests your conviction. Because sooner or later, every investor faces that moment of doubt, when a falling stock tempts them to believe they found a bargain, or traps them into holding a loser. And it's in those moments that Graham's final lesson,
one about patience, temperament, and time, reveals its true power. In the end, Graham's most enduring insight wasn't about numbers at all. It was about temperament. He believed that the true challenge in investing wasn't finding opportunities, it was behaving correctly when those opportunities presented themselves. He often said, the investor's chief problem, and even his worst enemy, is likely to be himself. That statement might sound simple, but it captures one of the hardest truths in markets. Many investors fall into value traps not because of poor analysis, but because of poor patience. They demand results on a schedule the market does not obey. Graham learned this lesson firsthand during the 1930s. After the crash of 1929, he bought several deeply undervalued stocks, but many took years to recover. During that time, investors around him grew restless. They wanted fast profits, and when those didn't come, they sold, often just before the rebound began. Graham, however, stayed disciplined. He understood that price and value often diverge for long stretches, and only those with the courage to wait are rewarded. He compared the market to Mr. Market, a character he famously introduced in The Intelligent Investor. Mr. Market is your emotional business partner who offers to buy or sell shares every day. Some days he's euphoric and quotes absurdly high prices. Other days he's despondent and offers you a pittance. Your job as an investor is not to follow his moods, but to take advantage of them. Graham wrote, "You are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right." That simple line holds the key to avoiding value traps. Truth is not determined by price movements. Consider the 2008 financial crisis. Stocks collapsed across the board, and even great businesses were selling for what seemed like absurdly low prices. Those who panicked and sold at the bottom locked in their losses. But those who applied Graham's temperament, focusing on intrinsic value, not fear, found life-changing opportunities. One of the clearest examples was in the banking sector. While many institutions were doomed, others with strong balance sheets were dragged down by market panic. Investors who distinguished between the two, who analyzed and waited, were able to buy solid franchises at prices that implied catastrophe. In time, those positions multiplied several times over. The same dynamic plays out in every decade. The market oscillates between greed and fear, optimism and despair. Graham's wisdom reminds us that the investor's edge lies not in forecasting the next swing, but in staying rational when others are not.
That's why he placed temperament above intelligence. He once said, "To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks." The difference between satisfactory and superior often comes down to patience, the ability to hold on when your analysis tells you you're right, even if the market disagrees temporarily. In today's fast-moving world of algorithmic trading, quarterly results, and social media speculation, that lesson feels more relevant than ever. Most investors are trapped by their own need for immediacy, constantly checking prices, reacting to headlines, chasing trends. But as Graham taught, enduring success belongs to those who can step back, think independently, and let time do the heavy lifting. Avoiding value traps, then, is not just about identifying undervalued stocks. It's about cultivating an investor's mindset, skeptical, patient, and rational. It's about refusing to let excitement or panic dictate decisions. In that sense, Graham's teachings transcend investing itself. They are lessons in human behavior, in how to remain calm in a world of noise and persuasion. He saw investing not as speculation, but as a test of character. And perhaps that's why his philosophy has lasted for nearly a century, while countless strategies have come and gone. As I reflect on Graham's legacy, one truth stands above all others.
Successful investing is not about predicting the market, but about protecting yourself from it. If you can master that, if you can think independently, buy with a margin of safety, and hold with patience, you will not only avoid value traps, but you'll become the kind of investor Graham envisioned: enterprising, disciplined, and truly intelligent. And that, more than any secret formula, is the real key to long-term success.